Have you ever opened up your tax return, seen the number at the bottom and thought, that can't be right? Same job, same income, nothing wild happened this year. And somehow you owe way more than last year. Here's the thing, that's usually not because you messed something up. It's because tax bracket creep quietly showed up while you weren't looking. And no one warns high earners when this is happening, because on the surface, everything looks fine. Your paycheck hits, taxes are coming out, your pay stub looks clean, and you assume, okay, we're good. But what actually is happening behind the scenes is your income is stacking across brackets, across surtaxes, across different types of income. And by the time you see the full picture, the year is already over. And that's why so many high earners get blindsided at tax time. Not because they don't make enough, not because they don't save, but because they never see their true taxable income clearly until it's locked in. And this isn't about paying the least amount in taxes right now. That's short-term thinking. This is about having a tax plan so you're not accidentally pushing yourself into higher tax rates today or building a much bigger tax problem for future you. In this video, I'll show you how to see your true taxable income before you file, so you don't accidentally push yourself into a higher tax bracket. How different types of income, like bonuses, RSUs, and investments, quietly stack on top of each other, and how to build a tax plan that avoids surprises, not just this year, but over your entire lifetime. Before we get into the numbers, I want you to picture something simple. Imagine an ice cube tray sitting in the counter. Each compartment of that ice tray represents a tax bracket. The first compartment is the lowest bracket. The next one is the next rate, and so on. So now imagine your income like water. You don't pour water in all the compartments at once. You start with the first compartment. You fill it completely. Then you move to the next one, the next, and the next. And only the water that goes into each compartment is taxed at that rate. That's how the US tax system actually works. And most high earners understand that conceptually. Where things break down in real life, because most people think of income as one pour, their salary, but income doesn't show up that way. Throughout the year, you keep coming back with the picture. Your paycheck, that's a pour. A bonus, another pour. RSUs vesting, another pour. Your spouse's income, another pour. Investment income, another pour. You're starting to see a pattern here. And because no one is standing there watching the tray, you don't notice when one compartment fills up and you quietly move into the next one. There's no alert, there's no warning, no moment where you say, hey, the next dollar is about to be taxed different. You only see the full tray when the year is already over. That's tax bracket creep. Not earning too much, not doing something wrong, just pouring into the system all year without ever stopping to see which compartments are already full. That's why people say, we didn't do anything different, or our income didn't change that much. It didn't feel different, but the tray filled differently. If you don't stack every income source into one number during the year, bracket creep just happens to you. Now, here's where the tray starts to mess with people, because even once you see the total, not all pours are treated the same. Let's use real numbers. For married couples filing jointly in 2026, you don't touch the 32% bracket until taxable income is just over $403,000. Once you cross about $512,000, every new dollar is taxed at 35%. Above roughly $769,000, you're in the 37% bracket. Those are marginal rates, just the water in that compartment. Now, here's the problem. Payroll doesn't withhold based on where your tray actually is. It withholds as if each pour exists in isolation. Bonuses are the classic example. Most bonuses are withheld at a flat 22%. If your tray is already in the 32 or 35% bracket, that's not even close. Let's say you end the year with $550,000 of taxable income. Your marginal bracket is 35%. You get a $100,000 bonus, payroll withholds $22,000, but that bonus didn't go into an empty tray. It went straight into the compartment taxed at 35%. That's a $13,000 gap, isn't a mistake. That's bracket creep. RSUs work the same way. They're taxed at ordinary income when they vest. Another pour. But the withholding often has nothing to do with your real marginal rate. Investment income adds another layer. Once your adjusted gross income crosses $250,000, an extra 3.8% net investment income tax stacks on top. And that threshold isn't inflation adjusted. This is where a lot of high earners think they're being smart and accidentally create the biggest tax problem. Once people see the tray filling faster than expected, their instinct is always, how do I reduce my income? Traditional 401ks are the go-to move. And yes, they reduce taxes today. But reducing taxes this year is not the same as reducing taxes over your lifetime. A traditional 401k doesn't make taxes disappear. It moves water into a different tray labeled tax me later. If you're a high earner now, saving aggressively and building wealth, there's a good chance you'll still be in a high tax bracket later, which means you're growing a future tax problem. I had a client earning over $250,000, maxing traditional accounts purely for the deduction. On paper, it looked great today, but the analysis showed a massive tax deferral balance, large future RMDs, and very little tax-free flexibility. When we switched to Roth contributions, the paycheck drop was uncomfortable, but what he gained was control, assets that will never be taxed again, flexibility later in life, and options. This isn't about paying the least tax this year. It's about intentionally deciding which tray you're filling. Taxable now, taxable later, or tax-free forever. Deferring income isn't bad. Deferring income without intentions is. Deferrals don't eliminate taxes. It gives you control over when the water hits the tray. That matters if you're near a bracket threshold, a surtax, or dealing with a one-time income spike. Maybe you push a bonus into January, split capital gains across years, delay an invoice a few weeks. You're not avoiding taxes, you're choosing timing. Deferral without a plan is just kicking the can, sometimes into a more expensive year. The goal isn't delay at all costs. The goal is deciding when the pour happens and making sure it lands where you planned. This is where people say, but taxes are coming out of every paycheck. Payroll feels like someone's watching the tray. They're not. Payroll only sees one pour. It doesn't see bonuses coming, RSUs vesting, your spouse's income, or investment surtaxes. So while you think someone's monitoring the compartments, no one is. Many households earning $250,000 to $600,000 and beyond need effective federal withholdings in the high 20s to mid 30s once everything is considered. Payroll almost never gets you there. That's why quarterly estimated exists. Because high earners should never be surprised by a tax bill. If you're surprised, it's usually because no one was actually watching the trays. And this is where tools like an HSA actually matters. Not because they're flashy, but because they give you control without creating future problems. An HSA is one of the only places where the water never gets taxed. Deductible going in, grows tax-free, comes out tax-free for medical expenses. You're not shrinking today's tray just to build a bigger one later. You're redirecting water into a compartment that never gets taxed at all. And then there's tax loss harvesting. That's not about losing money, it's about using volatility to regain control. Losses can offset gains, offset ordinary income, and carry forward indefinitely. They act like a release valve, slowing how fast the tray fills. When done correctly, it's not market timing, it's tax management. And if RSUs are part of your compensation, this is where bracket creep shows up fast, because RSUs don't just affect income. They affect withholdings, marginal rates, and whether you get taxed twice on the same dollars. I break this entire process down step by step in another video called How to Minimize Taxes on Restricted Stock Units and Avoid Double Tax. If you want to understand how RSUs actually fit into everything we just talked about, click right here and watch that next.